Jamie Dimon, CEO of JPMorgan Chase, warned on Friday that the global trade war is contributing to an increasingly uncertain economic environment. He said the economy is facing considerable turbulence, including geopolitical tensions, with potential positives from tax reform and deregulation, but also serious negatives from tariffs and trade wars. Despite strong revenue growth in JPMorgan's markets and investment banking divisions, Dimon cautioned that recent turmoil poses a threat to those units. Clients, he said, have become more cautious as market volatility increases due to geopolitical and trade-related tensions. Inflation, according to Dimon, remains sticky, particularly in sectors like housing, which haven't seen relief from the steep price hikes of recent years. Even though the U.S. Bureau of Labor Statistics reported the lowest annual inflation rate in 6 months, economists remain concerned about rising inflation following President Trump's sweeping tariffs. Dimon also highlighted other risks, including high fiscal deficits and overall volatility. As always, we hope for the best, but prepare the firm for a wide range of scenarios, he said. JPMorgan posted $14.6 billion in quarterly earnings, beating Wall Street estimates, and saw its stock rise 3.4% in pre-market trading. The bank kicked off an earnings season that investors are closely watching for signs of stress under Trump's tariff regime. But beyond the stock market, the bond market sent an alarming signal. Earlier this week, both global stocks and U.S. Treasuries sold off simultaneously, an unusual and unsettling event. Typically, during a crisis, investors sell stocks and move into safe haven assets like Treasuries. This time, that didn't happen. The bond sell-off was so troubling it reportedly spooked the White House. People were getting a little queasy, Trump admitted, adding that he was closely monitoring the bond market. The volatility even prompted Trump to delay some of his planned tariffs. According to Jefferies economist Mohit Kumar, the blink came sooner than we expected, probably forced by the markets. On Wednesday, the yield on the 10-year U.S. Treasury note spiked to 4.5%, a sharp reversal after falling below 4% just days earlier. Yields have since dipped, but early Friday they were climbing again, sitting at 4.4%. Meanwhile, the U.S. dollar fell to its weakest level against the euro since February 2022, dropping nearly 2% to $1.14. The U.S. dollar index also weakened 1.3% as trade tensions escalated. In Europe, stock markets opened higher but quickly turned negative after China hiked its retaliatory tariffs on U.S. goods from 84% to 125%. The Stoxx 600 index was down 0.9%. France's CAC 40 and Germany's DAX also dropped, while London's FTSE 100 slipped 0.2%. Beijing made it clear the 125% rate may be the limit, but strongly criticized the U.S. for weaponizing tariffs. This has become nothing more than a numbers game, with no real economic significance, said a Commerce Ministry spokesperson. If the U.S. insists on continuing, China will not engage. But if the U.S. substantively harms China's interests, we will fight to the end.